Good afternoon, ladies and gentlemen, and welcome to the Sylvania Platinum Interim Full Year Results Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and we'll send you an email to notify you when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you could give that your kind attention, we'd be most grateful. And I'd now like to hand over to Jacko Prinsloo, CEO from Sylvania Platinum. Good afternoon.
Good afternoon, Mark, and good afternoon, everyone is on the call, and thank you for joining us for this presentation. And it's a great opportunity for us to again engage with you on this platform. I think it's the third Investor Meet Company presentation that we do, and it's been proved very useful in the past, and the feedback is very valuable. So thank you very much for joining in and giving us the opportunity to engage with you. Myself and Luanne Carminati, our CFO, will be taking you through the presentation to try and highlight the most significant points, and as Mark said at the end, we'll try and address some questions for you. Just to kick off, if you look at the 2021 as a year in summary and just a snapshot, I think it's a year we're very pleased of. I am very proud of what our team have managed to achieve this year. We've managed to achieve our stated forecast of 70,000 ounces for the year, and although it's only marginally up about 1% from the previous year, it was done under difficult circumstances where we've been experiencing lower feed grades and PGM recoveries from the ore mix we have, and our plants, every single plant exceeded their production capacity, and we've had a 17% increase on overall tons treated for the year. Then combining that with the favorable PGM basket price we've experienced during the year, we've had on our specific basket about 83% increase year on year on the basket price, primarily boosted by rhodium, to which we have a unique exposure. But so a very good environment for us, and those production combined with the basket price assisted us to post record revenue and profit figures for the year, and our revenue was up 79% year on year, and the net profit 143% up. And with all of this and the cash we've been able to generate, we in a fortunate position where the board have been able to declare a dividend of 4 pence for the financial year past, and which will be payable in December. And that's following on from the recent 3.75p windfall dividend we have just paid in April this year. So overall, I'm very pleased with the results. The two areas that we do need to focus on and are focusing on is the PGM recovery, which I've mentioned now, and I'll touch a bit more shortly on it. And then the other one is group operating costs, our cash cost, and Luanne will elaborate a bit more in her presentation on it. If we just look at our safety, sustainability, and ESG, and I think we all would know that ESG means a lot of different things to a lot of different people. But obviously for us at Sylvania, it means those systems, principles, and activities that shape the culture of our organization and how we interact with both our environment and the communities. We have been very strong on ESG elements throughout our history as an organization, with excellent safety records, good engagement with our communities, excellent environmental records. So it's something we've always been doing. It has been entrenched in our values and properly communicated and lived by our employees. We do recognize in recent years and probably more months than years, especially the focus on specific ESG reporting in line with the United Nations Sustainable Development Goals has become a lot more important for investors and institutions to see in order to benchmark companies, and we are focusing a lot more now to try and align our reporting in that regard. But as I said, we've always had a very strong performance and will continue to perform in this regard. Just touching on some of the elements of our safety, health, and sustainability in the ESG parts, from a safety perspective, on its own, we've had an excellent track record to date. In just over 14 years of operation, we've been fortunate enough not to have a single fatality to date. And I mean, part of our low-risk business model, where we don't have any underground mines, it assists us to achieve that in that regard. We do, however, focus then on the next significant injury, and that is lost time injuries. And we are very proud that we have operations like Doornbos who have achieved 9 years LTI-free or lost time injury-free during the year. We have unfortunately had 2 lost time injuries across the 6 operations, and that was at Millcell and Tweefontein. But I think also worth pointing out that Tweefontein was at 8 years LTI-free at the time, and Millcell 5 years LTI-free when they had those accidents. So I think overall a very strong record. In terms of environmental, we've also been fortunate that we haven't had any environmental incidents since the inception of the company, or significant incidents, any reportable incidents. And we are focusing a lot more on getting now carbon footprinting and assessments done, and understand where we stand in terms of the more parameters, the reportable parameters, as I mentioned earlier, in terms of the ESG. One of the areas where I think we've made great progress during the past year was in terms of processed water consumption, where we've decreased our consumption, improved our efficiencies by a reduction of 8% year on year. And a large contributor to that was our initiatives where we are recovering scavenging seepage water on the perimeter of our tailings dam facilities and returning that to the plants. And that has been very good to us. And then finally, just on energy consumption, we have significantly lower energy consumption per ton treated than conventional mines and primary producers. So again, a very good achievement there. If we look at our employees and communities, obviously both our employees and communities are extremely important and critical for us to achieve the success of our business, and we continually engage with both of them, and there are various initiatives and that one could list and discuss. But maybe just to point out one or two on the employees, probably one of the ones we are the proudest about is the rollout of our employee dividend entitlement plan during the period, where we are giving our our employees the opportunity to share in dividend payments. And we've already in the past year, they shared in the annual dividend for 2020 and also the windfall dividend. From a community point of view, again, as I said, there are various ones we do, but I think what was positive for me during the past year was especially in terms of the success and the fruits from our training learnership programs, where we train specific employees from our communities in terms of metallurgical and engineering skills, artisans, which are the scarce skills, and we have quite a need on operations, and we've been able to employ quite a couple of people completing those learnerships successfully. And I think that's a good indication to us that we're just not employing at the low level of where the employees are in the community, but we're also upskilling them and making a difference. Okay, if we turn our attentions more directly to the operations, and just to orientate you a bit on where our operations are situated. Our operations are typically situated in the northwest and Mpumalanga provinces of South Africa, and that's almost in the central to northern part of the country, on the eastern and western bushveld, respectively, of the bushveld complex in South Africa, where all the PGMs and chrome resources are situated. The orange dots indicate our Sylvania dump operations that are currently in production and currently adding revenue and ounces to the business, and while the green dots indicates our exploration and mineral asset projects on the northern limb the Bushveld complex. When we look at the production profile for the past year, you can see we've had the 70,000 ounces, and we are again forecasting to do 70,000 ounces for this for the 2022 financial year, and then we are forecasting growth around 72,000-73,000 ounces up to 2023 and 2024. That particular growth specifically is coming from the execution of our Lesedi and Tweefontein MF2 projects. That Lesedi to be commissioned in the second half of this financial year, and then Tweefontein in the first half of the next. These modules are similar to the previous Project Echo modules we rolled out, proven technology, proven benefits, and we're quite confident that it's a low risk addition to the business. And on the negative side, only a mild setback in terms of our Lesedi operations, where we had to temporarily suspend our production during August related to tailings dam, but I'll discuss that a bit more in the focus area slides. So just looking at the opportunities, and I think I've mentioned already the secondary milling flotation, which is quite proven and a concept that we've identified long ago. So I'm not going to touch too much on that now. I think we've been talking for a long time and said where would external growth opportunities come from, and we continuously engage with third parties or external parties to identify and evaluate resources. One such example is an offtake that we've managed to secure during the past 6 months, and where we see it as in the near term and immediate to near term about 2,000 to 3,000 ounces PGMs per year we can do. But we are also embarking on further sampling and evaluation work to see how we benefit and explore and optimize the assets to gain more PGMs. Most chrome miners, when they develop the mine and the process, focus purely on the chrome part of it, and once you add, especially in the current market environment, you add the PGM side to the business, you are able to achieve a lot more with the business. Fine chrome recovery is also one of our R&D initiatives that is turning into a commercial opportunity now, and that's where we're focusing on recovering the really fine chrome that our current plants are not able to recover, and that unlocks the potential from tailings dams historically sterilized or deemed sterilized, that you can unlock that now. So the idea is that you supplement your PGM revenue stream by increased chrome revenue stream from those products, and therefore you can retreat lower grade dumps again and extend life of operations, and we are well advanced with some of those opportunities. And then obviously, our strong cash position assists us to enable us to do all that R&D and growth. On the challenger side, and I think just maybe to touch on, and I've said earlier, we've been experiencing lower recoveries and PGM grades because of the ore feed blend, and that's still associated with our host mine slowdown that started about early last calendar year, related to the downturn in the chrome markets. We are seeing the chrome markets to recover, but based on our formal communications we've had to date, we expected the scenario to last another 6 to 12 months. But there are already signs from other chrome miners and analysts to say that the chrome price sticks to say it's the current trajectory that there might be upturn sooner. However, in the meantime, because we are supplementing these current risings and raw material with open cast sources, it's more oxidized, it's typically lower grade, and that has a knock-on effect on both our costs and the process efficiencies. The suspension of the Lesedi tailings dam, maybe to put it in perspective, that is the current tailings dam has been commissioned in about prior to 2009 on the Lesedi operation, which was then known as the Phoenix operation, and Sylvania acquired that operation in 2017. So what we have determined through our routine inspections and monitoring activities on the mine is that there's an increase in the phreatic surface or the water level in the dam. that would mean that we could sacrifice the integrity of the dam if we continue to operate and don't implement mitigating measures. So we have taken the proactive and cautious approach to rather suspend the operations at Lesedi, and so that we don't put the operation or environment or our people at risk. We are, as I said, busy with a couple of mitigating measures to try and see if we can get that operation running in the next 4 to 6 weeks. We also in the process of constructing the new Lesedi tailings dam, which has been designed and approved quite some time ago already, and has always been the plan to go into that dam by the end of the year. And we are just now balancing the period in between. In terms of the COVID pandemic, we were fortunate even after the phase 2 and the second and third waves that we haven't had any significant any production interruptions, and our productions continue. We continue support to our employees and their families where they are as individuals affected by the virus. Just to maybe put a bit of the growth plan in perspective, I did mention probably most of these initiatives that we are working on at the moment, but this graph at the bottom in the table just illustrates that our initial years was primarily growth by adding new plants. You know, we started with only 1 plant with Millsell, building up to 7 plants by 2013. And so initially it was growth by adding capacity. Between 2013 and 17, you know, we were working on efficiencies, plant throughput rates and all that. And really, if you can call it almost breakthrough decision in 2017 was to execute Project Echo. Now, I think at the bottom of that graph, you can see the black line that shows where we would have been in terms of our ounce profile had we not done Echo in 2017 or from 2017 onwards. And a lot of times people see growth purely as the quantum of ounces per year increase, but we have also managed through our R&D initiatives and our technology to grow the company in terms of more resources, more ounces for longer and revenue, and enable us to be a steady dividend payer at the moment. So we continue, as I said, with the next 2 phases of that same technology, but then we are also focusing a lot more now on new resources and capacity, and to see how do we add on. We have a skill set and experience in our company that can handle and manage operations efficiently and successfully, and we're looking at how to leverage that, and we're continually engaging with third parties to see how we merge that our PGM skills and experience with available resources. If you look on the exploration assets and our mineral assets, I think just a brief update. There's not a huge lot that happened here during or since the last presentation in February. We announced earlier that we've launched an additional drilling campaign at the Northern Limb resources, and that is now approximately 56 and 25% complete for the 2 respective resources, and we expect the drilling results and final reports by about mid next year, so say June 2022. On the fault spread front, our initial mining studies and process test work has been completed, and we are now busy evaluating the PGM concentrate processing routes and offtakes as alternatives to determine what would be the best viability to get on that in order to inform our business model. And we're also just looking at the alternative geological interpretation of the resource to see if we can get a higher grade out of it and streamline the resource. But there will be more to report on this after June next year. Okay, and with that, I'm going to hand over to Luanne just to take us through the financial performance, and then I'll do a close for us at the end.
Thanks, Jaco. As you all have noted when Jaco went through the snapshot, Sylvania's had an exceptional year financially and reported record revenues and profits. This is mainly due to the basket price, but still an exceptional year for us. Net revenue increased 79% on the prior year. The increase in the basket price resulted in an increase of $89 million, and the slight increase in ounces added an additional 1.7 million. The high rhodium price over the financial year accounted for 60% or $123 million of the total revenue, platinum 17%, and palladium 14%. Ruthenium and iridium, together with copper and nickel, made up 6% or $13 million. The sales adjustment relates to the ounces delivered at the end of financial year 2020, but only invoiced in the current year as a result of the 4-month delay from delivery to invoice, which is in terms of our offtake agreements. On the costs, unfortunately, but not unexpectedly, the SDO direct operating costs increased 19% on the prior year in dollar terms. The increase in operating costs over the year on year was a result of the electricity incurring an average 14.5% increase over the year and higher usage at some of the plants. The 2022 increase has not been confirmed as yet, but is expected to be at least in line with 2021 or possibly higher. We had higher remining costs incurred in order to supplement the lower ROM and current arisings from the host mines. And then this resulted in the higher oxidized open cast ROM and dump material at some of the operations where the reagents included in consumables was higher. Going forward, we anticipate costs to come down slightly as the remining costs stabilize and production increases once the Lesedi and Tweefontein MF2 modules are commissioned in 2022 and 2023. It is, however, pleasing also to note that despite the increase in our costs, Sylvania is still one of the lowest cost producers, which can be seen in the Nedbank cost curve graph, which we've included in the appendix of this presentation. You'll see there we still remain in the lowest quartile. The group EBITDA, we had an EBITDA of $144 million this year, driven again by the metal prices and stable ounce production. Forecasting forward at August prices, where we've seen a pullback in the PGM prices, the EBITDA is slightly lower at the consistent 70,000 ounce target for 2022. For 2023 and 24, we're forecasting increases due to the increase in ounce forecast and slightly lower cash costs. You can see from the various analyst and consensus outlooks that have been included here that it's anyone's guess what the price will do. And even at the lower forecasts, the group still remains profitable. We're currently forecasting somewhere in the middle of the analyst forecast, and we're quite comfortable with those forecasts. Moving on to our capital, we had a capital spend for the year of $7.5 million. This includes both the SDO capital and the drilling program on the Northern Limb assets. The SDO capital includes stay-in business, the Lannex ROM plant, the ultrafine screening project at Mooinooi, and 2 of the 5 tailings dams commenced in the current year. And this cost is included in our SRB. For 2022 and 23, capital is higher than previous years, as it includes all 5 tailings dams and the Lesedi and Tweefontein MF2 modules. And then the balance of the Northern Limb drilling program is also budgeted in 2022. From 2024, we're only forecasting SRB at this time. Jaco did mention the 2 growth projects we're looking at, but as the production and revenue forecasts haven't been included in our forward-looking numbers, we haven't included any capital forecast here either. On our cash flow, our cash balance increased from the $55 million last year to $106 million, a 90% increase on the prior year. The inflow from operations was $68 million, and again, this was mostly on the back of favorable metal prices, but also stable production under sometimes difficult circumstances. Included in this net inflow is a $32 million movement in working capital, $1.6 million interest received, and $48 million paid in tax. We've also in that cash flow from operations is the $8.2 million we paid in mineral royalty tax. Outflow from investing activities was $7.6 million, of which $7.5 million was spent on capital and E&E assets, as previously mentioned. The outflow from financing activities was $22 million and comprised the payment of the financial year 2020 dividend and windfall dividend, which totaled $20 million, and then $1.6 million was spent on share buybacks. The board's very pleased to have declared a 4 pence dividend for this financial year, and that equates to about $15.5 million at the current exchange rates and will be payable in December this year. The company remains committed to returning value to shareholders. The board has declared a 4th consecutive annual dividend of 4 pence, and it's calculated in terms of our current dividend policy, which takes into account liquidity and forecast working capital cash requirements, debt covenants, which are currently 0 for us, but is one of the factors included in the policy if we were to enter into debt, forecast capital spend, forecast metal prices, and of course any legal considerations in terms of the Bermudan Companies Act. But most importantly, the payment of dividends must be sustainable in the long term. The board's also taken a decision that we'll again do a windfall calculation for the 2021 calendar year. And if the average price received for PGMs for the year is higher than the consensus pricing, there may well be another windfall dividend payable in declared in Feb, payable around April. With regard to share buybacks, this always remains on the board's agenda. Unfortunately, we are limited to when we can buy back shares and can only do so when the company is not in a closed period. So where the recent drop in our share price would have been an opportune time for buyback for shares in the market, the company was unable to do so as we were in a closed period until we released our results today. We have, however, over the last 7 years, bought back 47 million shares and cancelled just short of 13 million shares. I'll hand you back to Jaco now to go through the forecast and company outlook.
Thank you very much, Leanne. And I think just before we look at pricing, maybe just a recap again in terms of our basket price. And Sylvania, as you might know, as mining 2 distinct chrome tailings resources. The one is LG6 seams that have a rhodium content of up to 16%, and then middle group or MG seams that is slightly lower. But both of those resources are of significantly higher rhodium content than your typical UG2 or Merensky reefs that the primary platinum mining companies are mining. So overall, at almost 13% average rhodium exposure for our resources, it is a very attractive position to be in. It unfortunately is also a difficult place to be in when you have a rhodium price falling, like we've seen in the recent month or so, and you tend to get harder, a lot harder than many of your competitors. However, we've seen the strong increase in the rhodium price over the past year, and we were, as Leanne also mentioned earlier, 168% up year on year in terms of rhodium, and also attractive increases on our basket price and for our metals. And overall, our average basket price was 83%. I think it's important when we look at the markets that we remain cautiously optimistic about the markets. We do believe the markets are still robust, but the sharp decrease in the rhodium price recently has just indicated to you that you have to be aware of the volatility. If one look at what to forecast, and I've just put here the assumptions that we've used in some of the forward-looking graphs in the presentation, and indicated to you the sensitivities on the EBITDA graph earlier. And we've listed here Nedbank investment, corporate investment banking, Standard Bank securities, and also Ernst & Young consensus forecasts. And you can see that on platinum and gold, everybody is fairly well in alignment. Palladium, there's a little bit more of a spread, but when it gets to rhodium, there's quite a big discrepancy in terms of what to expect in this next year. And so going forward, you would have the Nedbank and EY forecast saying, you're around $16,000 to $18,000 an ounce for rhodium in the next year or so, and then steadily declining, and Standard Bank again have it higher. And if you add 4 or 5 more institutional analysts here, I get 4 or 5 more scenarios. But I think what I just want to illustrate is there is some variability. We are looking at that variability all the time and trying to ensure that we assess. But I think most importantly, what it makes you realize is that we can just focus on the things we can control. It's nice when we have an upswing in the market and you have the benefit. But I think the key to our success in the business is focusing on what we can control and looking at streamlining and growing the business. So if we look at the year ahead and saying, okay, what it is that we're going to continue doing, I think first and foremost, ensuring that we continue with safe and profitable production. It is that stable and profitable production that have been generating our cash during the years and been able to fund our growth projects. The last time we've relied on institutional or shareholder funding was back in 2009. And we haven't raised money since then. It was all funded out of our growth and revenue generation. And then obviously focusing on our license to operate, and that goes both in terms of all the ESG principles, regulatory communities, government organization, but also very much our host mines, and ensuring that we maintain that synergistic relationship. That will enable us to then carry on with more R&D, continuing to focus on the process and the technology that can give us benefits, and also the exploration projects and that we've mentioned, Volspruit and the Northern Limb, that would be adding value in your mid to longer term, 3 to 5 years and thereafter from now, depending on what the outcome of those studies are. And then I think probably the most significant focus of the next financial year is to be more aggressive in terms of our external growth opportunities. As I said, with the recent PGM markets, there's been a lot more interest and appetite from existing chrome mining operations to look for strategic partnerships in terms of PGMs to unlock value in the near to mid-term. And we are definitely aggressively pursuing those options. And so just to summarize, we are looking at doing 70,000 ounces again this year, and we're confident that we should be able to get it. We do believe the market for PGMs are still robust, in particular palladium and rhodium that remain in deficit throughout the year, and good demand for the PGMs still in the automotive vehicles, and we believe the prices will remain healthy and robust. In terms of capital, obviously, with the number increasing quite significantly from previous years, investors are worrying and say, are you not just spending this capital too easily? And we just want to give you the assurance that we are very diligent with our capital allocation programs and our discipline in controlling it. And very specifically, we've committed capital, firstly, to growing the PGM ounce profile through strategic project improvement, and those are like the Lesedi and Tweefontein MF2 projects. Then the tailings dam storage facilities we're increasing is at Lesedi, Mooinooi and Doornbos, the current dams we're building. And that is specifically aimed at extending the life of operations at those mines and improving our operational flexibility in terms of how we do feed sources and what other historical dams we are able to remine. And, I think important to note, when Sylvania initially started back at the first plant in 2008, the idea was that in 5 or 10 years' time, these operations would have been done. And by improving technology, by our R&D, by expanding the processes, we've managed to prolong this business to a business that has another 10 years plus in it. So the tailings dams construction and focus now is to cater for that extended life. And then finally, I've already spoke about the exploration assets that is longer term. So, but we do need to see how we improve those assets and business case, so to decide how we're going to progress with those projects going forward. And then I think I've mentioned already that our dedicated focus on strategic partnerships and external growth opportunities is receiving a lot of attention, and one of our big focus areas. And then just finally taking all of it, the above in consideration, what I've discussed in the presentation, the strong operational background we're coming from, the consistent delivery during the past couple of years, the strong financial performance, our strong cash balance. makes me excited about the next financial year. And I think the board as a whole is very confident and excited about the year, and look forward to the rest of 2022 with confidence. And hopefully we can provide you with some very positive feedback and update you on the progress as we go along during the year. Yes, and that I think brings us to the end of my presentation, Mark, and I can maybe hand back over to you.
That's great. Jaco, Luan, thank you so much for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind
Mark, I think that brings us to the end of the presentation. I'm not sure. I see that I've muted the mic here. I'm not sure how long ago it was.
No, Jaco, you know I just muted you just to give you a small pause. So I'll bring you back off of mute in just 1 second.
Sorry, yes.
Perfect. I'd also like to remind ladies and gentlemen that your feedback is important to the company, and immediately after this presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Jaco, Luan, obviously investors had the ability to pre-submit questions, and I know you've also received a number during today's event. Perhaps I could hand back to you, Jaco, to address those questions. If I could ask you to read them out and where appropriate, give a response, and then I'll pick up from you at the end if I may.
Okay, that's 100%. Okay, I think, Mark, if I can start with maybe the first one. And somebody asked us, can you please give your views on the PGM commodity price movements and your thoughts on the outlook? And then there was a following question, and I grouped together the same theme. It said, also, could you please explain how you manage commodity price risk? If you use if you have sold futures and the market doubles, how do you consider cash flow impact of the margin payments, and have you considered using an option strategy? So I think when we look at the PGM prices and the market, I think I tried to maybe in those last few slides give an idea of it. I think, you know, what we have seen in the last few years, and people use rhodium specifically, and I think maybe we're focusing on rhodium since it's been making up 60% of our revenue in the past financial year, and it's a large exposure in our April. So I think rhodium being primarily South Africa producing more than 80% of world rhodium, that what happens in South Africa, I think, plays a big role in what happens with the rhodium price from a supply and demand. Well, from a supply concern point of view, we know that rhodium primarily consumed in the auto cats industry, and therefore the demand is strong. It has been impacted by the slowdown in vehicle sales, both related to COVID and also to the semiconductor chip shortage that recently hampered car production sales. But on the supply side, I think more importantly, when we saw the big increase in rhodium last year, it came on the back of the hard lockdown in South Africa, where most PGM miners were impacted for that 6 to 8 week period of COVID, when the government put the country on hard lockdown. And also in that same period where Anglo American Platinum's furnace blow up and downtime have happened. And Anglo, again, as one of the largest producers of PGMs in South Africa, and then South Africa and the world, those two events created quite a big shock from a supply concern point of view. And I believe that's one of the big reasons why we saw the rhodium price increasing significantly. There are obviously other reasons as well, but those two in particular have spiked widespread concerns about the future rhodium supply. And as the mine started ramping back up, and as the Anglo also started releasing the inventory, suddenly the supply of rhodium have eased, and we've seen a stabilization in the price. I think what's positive is that the rhodium demand and supply demand equation still is forecasted to remain in deficit. Rhodium, we know in its application in nitrous oxide gas emissions control, is unique, and unlike platinum and palladium, where you can look at substitution between the two depending on where the price go, rhodium is quite unique. So I think that remain robust and going strong. I don't think at the historical levels that we forecasted. I would be hesitant to give you a number. I think I've given a range in the presentation of where we expect it to be, but I think it's very difficult to pinpoint it. And with platinum and palladium, I think palladium definitely also forecasted to remain in a deficit, and therefore the price should be strong. People say, yeah, but what about substitution with platinum? And I think when that occurs, we will see an uptick in the platinum price again. And luckily, we have exposure to both of those metals in the market. And so on. I think hopefully that answers the part on the commodity price movements. In terms of us looking at futures or hedging on the metals, we don't have a hedging strategy. We don't sell any futures. And as a board, we've made a decision. The volatility and in order to predict what the prices are going to do is very difficult. And it's also not like there are many institutions. I think in South Africa there's one institution that is prepared to hedge rhodium, for instance. And I always use the example. I said that had we hedged 2 years ago, we would have missed the last year rhodium run. And at the time when we were seeing rhodium levels at $25,000 to $35,000 an ounce, you could afford that. Would be a good opportunity, but then there was also quite widespread forecast in terms of where it will go to. So no, we currently don't have a strategy and don't intend to in the short term to do that. So we are not exposed in a drop. So if the prices would pull back, we are selling at the market price and based on our off-taker. And so there's not any futures or hedging strategy there. I think if I go to the next question, it's related to power, and it said, how are the challenges of power supply impacting you in particular? Will problems at Medupi power station impact on production output at Sylvania in the next 3 years? So I think there are 2 points here. Generally, how are we impacted? And I did say in our results announcement, under some of our focus areas, we have had some downtime during the year, not related to load shedding in particular or related to the supply capacity of the national utility of Eskom, but more related to vandalism and cable theft of the infrastructure. And that's what we've been seeing. We as a group haven't really been interrupted by the capacity of power in the recent years. And even when we have the high stages of load shedding in South Africa, the mines manage to still keep on going. But the supply infrastructure from the surrounding communities and so on, that remains a concern, as unemployment after COVID certainly increased and poverty is high. We get more of those instances, and that does cause power disruptions. And we are working a couple of strategies to see how do those shorter term disruptions we address. When one look at the question about Medupi power station, and maybe for the people who are not aware of the Medupi story, and we've had in recent months, I think in this past month, there was an explosion at the Medupi power station where some of the generating units have been damaged. And I think if you look at Medupi on its own, I think it's less than 10% of the overall Eskom power generation. I think it's just less than 5 gigawatts, if I have it right. And I might stand to be corrected, but it's definitely less than about 10% of Eskom's total generating capacity. And since the explosion happened, in that first few days after the explosion, there was some domestic load shedding in the country, but since then, nothing big on the overall affecting the mining arena. So we don't anticipate that to necessarily have an impact on us. However, power in the mining industry remains a concern, and as the mining industry need to grow and our national utility supplies remains basically flat or even declining because of availability, sometimes it is high on the agenda. But government is trying to address that with a recently announced regulations that would allow mining companies or individual companies to generate up to 100 megawatt of power. There are some of the regulations around that is not that still needs to be clarified in terms of can you put it back in the grid and how you will be done. And I think that will alleviate also a load the national utility. I think in the last month or so, the Minerals Council of South Africa released a paper that just quoted that said that just some of the mining clients or members of the Minerals Council of Africa have already identified about 1.6 gigawatt of independent power facilities that they're ready to roll out. And I think that would be, those kind of initiatives would be significant help to alleviate the pressure on the overall power grid in South Africa. So I hope that would resolve it. But we're keeping our eye on it and continuously evaluating our options. Another question we got, and there was actually a few questions related, I think 4 or 5 questions, all asking about the impact of the recent civil unrest or social unrest in South Africa. And as I said, has that been impacting on Sylvania's operations at all? And I think we were fortunate enough that I can answer and say no, it has not. Our operations, as I showed on that map earlier, is in more to the central and northeast of the country, in Mpumalanga province and northwest, and most of those unrest and rioting and looting has been in the KZN, on the coastal areas, KwaZulu-Natal, and also in Gauteng, central. And we haven't been affected. That being said, I think it's important for us to maintain that good relationship with our surrounding communities and ensuring that, when there is instances like that, that you have at least the support of your neighboring surrounding communities. I think even in South Africa, some of you might have seen in the news that when malls and areas have been looted, you had other areas of a community standing together and protecting and helping the police and the armed forces to protect it. So I think it's always good maintaining good social relations with our communities, but we are fortunate that we haven't been impacted and don't expect to be impacted by any of the unrest that we have seen in July. I think there's another question to say, can you talk a bit more about fundamentals of the business and the likely impact of switching to EVs? And I think, and if I interpret it correctly, is if I assume EVs refer to electric vehicles, and then reading the question, I guess it's the investor was wondering the impact on metal prices with the switch of vehicles to electric vehicles rather than in normal combustion, conventional combustion engines, and would that have an impact because of a lower catalyst demand? I think there's when you look at the development and the trends in EVs recently, they obviously quite a variety of different electric vehicles that you can get, and it depends. Is it battery electric, hydrogen electric, fuel cell vehicles? So I think there is definitely worldwide we can see major progress in that regard, and the development is progressing quite well. But I think what is for us from a PGM market and company perspective quite encouraging is that a lot of the focus is at fuel cell and the hydrogen electric vehicles, where there's some form of that PGM still plays a role. And I mean, in some of the fuel cell vehicles, you even have a higher PGM consumption per vehicle than on the conventional catalyst. So I think there is a opportunity still there. I think when you look at especially ranges vehicles can travel, your more industrial trucks, buses, trains kind of vehicles, battery power on its own is becoming very expensive, very heavy to fuel it, and therefore hydrogen electric vehicles and fuel cell vehicles becomes a much more attractive option. And I think that's where we still expect PGMs to still play an important role. And I don't think in the near term we are overly concerned about that. And I think the markets, as we said earlier, should remain robust. Another question, and Mark, you must guide me on time. I'm not sure how much time we have. I'll go to one of the next questions.
Yeah, please, Jaco, feel free. I think there's a few more for you to go. If you could spare the time, that'd be brilliant. Thank you.
Another question I had is to say, will the company consider acquisition in the short to medium term? And I think, I've said that we are constantly looking at growth projects and opportunities. And I would never rule out acquisitions anywhere. We are in the fortunate position that we have a healthy cash balance and a good business model and a production or a revenue profile going forward that we certainly would be able to do that. But it's important for us that the investment fundamentals are attractive and that we can continue adding value. I think rather than maybe pure acquisitions, what we are seeing a lot more is more partnerships and also maybe pool and share kind of agreements. As I said, you quite often get chrome mining partners that have the chrome mining resource, but have realized through our business model and some of our peers in the industry that when you combine it with a PGM business case, you could actually mine chrome resources that in the current chrome market you would not want to exploit, and it would not be worth your while. And we are significantly, as I said, we are evaluating quite a few significant opportunities in that regard to see is there a business case that we can add value. So as I said, be it potential acquisition, but I think more probably partnerships, strategic partnerships, or pool and share agreements that we might typically consider.
Jaco, maybe it's an opportune time, because I can see for every question that you seem to answer, there's another 2 or 3 that follow shortly afterwards. I'm also mindful of time, and I know that you have a couple of meetings scheduled for after this. And thank you firstly to all investors that have taken time to submit their questions. And of course, all of these will be presented to the company for them to review, and where appropriate, we'll publish responses back to you. But perhaps, Jaco, I could just ask you for maybe one final question. I know investor feedback is important to you, and then we'll ask you for a few closing comments and then direct investors.
Okay, thanks. Okay, let me close off with this one. I think there's also, again, 3 or 4 different questions that had exactly the same line. And this one said, please, could you elaborate in detail on the contract life of mine and the growth initiatives moving forward? So I think, first of all, maybe addressing the contract life of mine. I think the one other question said, for how many years do you have still access to current arisings and ROM? So our existing agreement with our host mines, where we currently operate, are for the life of mine of those operations. And with our host mine being a private company and not a listed entity, you don't always have the full resource disclosures and the line of sight in the market. But we do know that we have it for the life of mine. They have a mineral right that is still approximately another 25 or 50 years. They have one of the largest resources, chrome resources, largest and most attractive resources still in the country, and I believe one of the largest in the world. So we believe there's quite a significant life of mine. What could change if we don't add growth projects? That the ounce profile could change. Where we're currently looking at saying we believe we could comfortably be between 60 and 70 or 75,000 ounces for another 10 years. After that, we might, when you rely purely on the current arisings and raw material, that could taper down maybe 10,000 ounces or so. That's still a profitable life based on our current pricing and cost assumptions. So we believe there's adequate life. But I think more importantly, and we have seen it during our initial growth profile this first couple of years, is that being the size company that we are, our fixed cost base is well, as I said, we have our fixed cost covered, but we have the potential with our current base to manage more and to unlock more potential. And if you add more ounces and you can grow that ounce profile, your unit costs can be lowered and becomes more attractive. So we certainly are looking into adding more growth projects. And as I think the previous 2 questions and what I said in the presentation covered that as well, that we are aggressively looking at opportunities. I believe there are some attractive opportunities available, and I believe that we are ideally and uniquely suited to add value in such a synergistic relationship, and that we would be able to grow the company going forward. So yeah, with that, I thank you for the questions.
Jacco, thank you very much indeed. And once again, thank you to everybody who submitted those questions. Jacco, look, I'm going to redirect investors to provide you some feedback so they can give you their thoughts and expectations. But perhaps before doing so, I could just ask you for a few closing comments.
Thanks, Mark. Look, I think as I started and said earlier, it's been a difficult year for us, particularly still dealing with COVID and more on a emotional and impact on the people rather than physical production related. And with the host mines being down, it presented challenges to us. But I'm extremely proud of how our team came together and overcame those challenges to produce a solid set of results. And I'm also extremely proud and very positive about the fact that we are able to again declare a solid dividend and have solid growth in our dividend, in our annual dividends over the past few years. Leanne is very quick to point out to me to say, listen, investors must not expect that you're going to double it every year. And I think we certainly, I would love to do that. But I think what we said is we want to be a stable and consistent dividend payer. And we want to return value to shareholders. And I think what we've been doing over the years and what we aim to continue to do should be able to put us in that position. So thanks again for all the support. It's not always easy. I think everybody else has his own ideas of how the company should be run, but hopefully we're doing it the best we can and in a way that returns value to not just our stakeholders here on the mines, but also to our shareholders on the call. Thank you very much.
Jacco, Leanne, thank you very much indeed for updating investors once again. Could I please ask investors not to close this session, as you'll now be automatically redirected in order that to provide your feedback, in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Sylvania Platinum, we'd like to thank you for attending today's presentation. That now concludes today's session. Good afternoon to you all.